Have you ever wondered what separates successful investors from the rest? Today, we're diving into the world of Benjamin Graham, the father of value investing. His book, The Intelligent Investor, has been a beacon of wisdom in the realm of finance, offering timeless principles for savvy investing. In this video, we'll be unearthing 15 key insights from this legendary guide, each one a stepping stone on the path to investment success. Dive in with us as we explore these valuable insights from one of the greatest investment advisors of the 20th century. First, we distinguish between investors and speculators. In the wise words of Benjamin Graham, an investor scrutinizes the fundamental aspects of a company, considering its earnings, assets, and liabilities, aiming for long-term growth. On the other hand, a speculator plays the risky game of short-term gains, often swayed by market trends and bypassing thorough analysis. The speculator's path might seem exciting, but it's like walking a tightrope without a safety net. Remember, investing is not about following the crowd, but about making informed decisions. Second, we discuss the concept of margin of safety. Imagine it as a safety net protecting you from potential investment losses. It's about purchasing securities for less than their worth, the difference being your margin of safety. This principle, central to Graham's value investing, allows room for errors, bad luck, or unforeseen events. It's not about avoiding risk, but managing it. If the investment doesn't work out as planned, the margin of safety helps limit the damage. Always ensure a safety net when investing. Third, meet Mr. Market, your erratic business partner. Picture him as a fellow who swings wildly from euphoria to despair, offering to sell you his share of the business or buy yours at prices that veer from absurdly low to ridiculously high. The trick? Don't get swayed by his mood swings. Instead, use his manic-depressive behavior to your advantage, buying when he's down and selling when he's up. Remember, you're in control. Don't let Mr. Market's mood swings influence your investment decisions. Fourth, let's delve into the essence of value investing. It's not about chasing the latest hot stock, but about analyzing a company's fundamentals, earnings, assets, liabilities. It's about digging deep, looking beyond the hype and buzz, and determining a company's intrinsic value. Value investing is about patience, discipline, and the courage to go against the crowd. It's about finding diamonds in the rough, companies that may be undervalued by the market but have strong potential. Remember, investing is about buying value, not just buying stocks. Fifth, we tackle the inevitable, market fluctuations. Picture a roller coaster ride filled with ups and downs. That's the stock market for you. But here's the rub. It's not the ride that matters, it's how you react to it. Benjamin Graham urges investors to embrace patience and discipline. Don't let the market's mood swings dictate your actions. Instead, stick to your investment strategy. Remember, investing is not about riding the wave, it's about staying afloat. So, stay calm and carry on investing. Sixth, we explore the concept of diversification. This is a strategy that involves spreading your investments across different asset classes, such as stocks, bonds, and real estate, to reduce risk. Think of it like this. It's safer to walk on a wide bridge than on a tightrope. But Graham cautions against over-diversification. Having too many investments can be as risky as having too few because it's harder to keep track of them all. Remember, don't put all your eggs in one basket. Seventh, let's talk about fixed income investments. In the world of investing, fixed income investments are like the steady, reliable friend who's always there for you. These are investments that pay back a fixed return on a regular basis, like bonds. They can provide a steady stream of income, which can be particularly appealing for those looking for more stability in their portfolio. But remember, while they may seem safe, they're not without risks, such as interest rate and credit risk. Fixed income investments can provide steady income, but they are not risk-free. Eighth, we delve into the stock selection criteria. Graham's approach to stock selection is rooted in the principles of value investing. He suggests focusing on companies that exhibit financial stability and have a consistent history of earnings. He also values companies that pay regular dividends. But above all, Graham emphasizes the importance of a margin of safety, which means buying stocks at prices significantly below their intrinsic value. This provides a buffer against potential losses. Choose your stocks wisely based on sound financial analysis. Ninth, we emphasize the importance of a long-term perspective. In the fast-paced world of finance, it's easy to become fixated on immediate gains, but Graham encourages us to resist this temptation. Instead, focus on the long game. Look at the bigger picture. Consider how investments will perform over decades, not just days or months. This perspective allows us to be patient, to weather the inevitable market fluctuations without panic. Remember, investing is not about making a quick buck. Investing is a marathon, not a sprint. 10th, we stress the need for emotional discipline. Investing is not just about numbers and trends. It's also a test of your emotional fortitude. Markets are volatile, they rise and fall, and it's easy to get swept up in the roller coaster of emotions that can come with it. But remember, successful investing requires a cool head. Fear and greed, they're your worst enemies. They can cloud your judgment, leading to impulsive decisions that stray from your investment strategy. Don't let your emotions dictate your investment decisions. 11th, meet the defensive investor. This individual prefers to take a more conservative, hands-off approach to investing. Rather than chasing the latest trends or attempting to time the market, the defensive investor opts for a well-diversified portfolio, often including index funds. This strategy allows for steady growth over time, minimizing the risk of substantial losses. It may not be the fastest route to wealth, but it's a reliable one. Defensive investing can be a safer route for those who prefer a passive approach. 12th, let's look at the enterprising investor. This is for those who are willing to put in extra effort into their investment strategy. It's about rolling up your sleeves and diving into individual stock selection. This approach isn't for everyone, as it requires time, patience, and a keen understanding of financial analysis. However, if you're up for the challenge, this strategy can potentially offer greater rewards. Remember, the key here is active participation and careful selection. Enterprising investing requires more effort but can offer greater rewards. 13th, we tackle the concept of market timing. Benjamin Graham was quite the skeptic when it came to the idea of timing the market. He believed that trying to predict the ups and downs of the market consistently was a futile endeavor. His advice leaned more towards focusing on sound investment principles, rather than trying to beat the market's rhythm. This is a crucial lesson for those who may be tempted to try their hand at predicting the market's next move. Timing the market accurately is a tough game to play. 14th, we explore bonds and preferred stocks. Bonds, essentially IOUs issued by entities, offer a fixed return over a specific period. Preferred stocks, on the other hand, are a class of ownership in a corporation with a higher claim on earnings and assets than common stocks. Both provide a steady stream of income and are generally considered less risky than common stocks. Understanding their nuances can help you evaluate their place in your financial strategy. Bonds and preferred stocks can be a stable part of your investment portfolio. Finally, we discuss the investor's mindset. It's all about adopting a business-like mindset. Imagine you're buying a piece of a business, not just a share of stock. This mindset encourages thorough research, just as you would scrutinize a business before buying it outright. It calls for discipline to stick to your investment principles, and patience to wait for the right investment opportunity. Remember, it's not just about making quick money, but about growing wealth over time. Investing is a business, treat it as such. Now that we've covered these 15 key points from The Intelligent Investor, let's summarize. We've journeyed through understanding the difference between an investor and a speculator, the importance of margin of safety, the metaphor of Mr. Market, and the essence of value investing. We've also delved into the concept of market fluctuations, the power of diversification, and the role of fixed income investments. We've explored stock selection criteria, the significance of a long-term perspective, emotional discipline, and the strategies for both defensive and enterprising investors. We've cautioned against market timing and explored bonds and preferred stocks, all while nurturing an investor's mindset. Remember, investing is not just about making money, it's about making informed decisions.